Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ZETA Global Holdings CORP quarterly report. ZETA Global Holdings Corp offers a range of businesses and services through its omnichannel data-driven cloud platform. These include consumer intelligence and marketing automation software ZETA Marketing Platform, analyzes billions of data signals to predict consumer intent using machine learning algorithms, consumer data platform, CDP+, delivers real-time identifiers and signals for consolidating multiple databases and internal/external data feeds Agile Intelligence Suite, synthesizes company and customer data to uncover consumer insights and translate them into marketing programs. The significant drop in ZETA Global Holdings Corp stock price over the past year can be attributed to a scathing short report published by Culper Research on November 13, 2024. The report accused ZETA of engaging in revenue round-tripping and improper use of consent forms, which led to a 37% crash in share price on that day alone. According to the report, ZETA's growth over the past 2 years was largely driven by its network of sham websites that tricked consumers into providing their data under false pretenses. While ZETA has denied these allegations, calling them falsehoods and speculation, the damage to investor confidence had already been done, resulting in a 41.76% drop in stock price over the past year. The primary drivers of revenue growth or decline can be summarized into several key factors. On the growth side, the company has seen significant increases in sales from Region A, new customer acquisition, and expansion into international markets. Additionally, higher usage among existing customers, new additions to the scaled customer base, and incremental revenues from both new and existing customers have contributed to revenue growth. The acquisition of LiveIntent also brought in $60.1 million in attributed revenue. On the decline side, disruptions in supply chain and a net loss have resulted in decreased revenue. Furthermore, a decrease in deferred revenue has also impacted overall revenue. Net income and profit margins. A shift towards stability, the financial performance of a company has shown signs of improvement over the past year. Despite a net loss, the magnitude of the loss decreased significantly from $17,375 in 2024 to $3,634 in 2025. This indicates that the company is moving towards stability and potentially profitability. Profit margins have also seen an upward trend. The adjusted EBITDA margin increased from 20% in 2024 to 23.2% in 2025, while the net loss margin decreased from -6.5% in 2024 to -1.1% in 2025. These improvements suggest that the company is becoming more efficient and better equipped to manage its costs. The reasons behind these changes are not explicitly stated, but they may be attributed to various factors such as cost-cutting measures, revenue growth, or strategic investments. Whatever the cause, the trend is clear. The company is moving in the right direction, with a focus on reducing losses and increasing profitability. The company's financial performance indicates a significant improvement in its ability to generate positive operating cash flow. In 2025, the company achieved an operating cash flow of $134,767,000, which is a substantial increase from the previous year's figure of $90,178,000. This upward trend suggests that the company is effectively managing its operations and generating sufficient cash to support its growth. The company's debt level has experienced significant changes in recent years. While the absolute debt value increased by a mere 0.3% to $196,884, a more substantial change occurred with the refinancing of a new credit agreement worth $550 million in August 2024. This indicates a notable shift in the company's financial obligations. Regarding interest expenses, there is some inconsistency in the reporting. However, it appears that interest expenses have decreased by $2.1 million and $6.8 million. The imputed interest also saw a decrease from $1,203 to less imputed interest. Overall, these changes suggest a reduction in the company's interest expenses. The financial performance of the company's segments reveals a stark contrast between the U.S. and international markets. The U.S. segment excelled, with revenue growth increasing by $63,711 and long-lived assets rising by $305. In contrast, the international segment struggled, with significantly lower revenue growth compared to the U.S., at just $11,962. This disparity highlights the company's success in its domestic market while underscoring challenges in its global operations. Management is optimistic about the company's outlook, citing growth in its scaled customer base as a key driver of success. They expect to increase platform usage among customers, leading to an expansion of their customer base. However, they acknowledge potential fluctuations in operating results due to presidential election years. In terms of strategy, management plans to continue concentrating technology and development work in India and other non-US locations to achieve cost savings. They also anticipate using corporate cash to make required tax payments associated with executive RSAs and withhold corresponding shares. Management is cautious about several risks, including payment-related issues due to customer disputes, decreased spending, and economic downturns. They also acknowledge the challenges of integrating acquisitions and strategic investments, which can divert management attention and disrupt business operations. The company has made several key transactions in recent times. In terms of acquisitions, the most notable include the proposed purchase of Marigold's enterprise software business for up to $325 million and the acquisition of Aptness through a stock transaction involving 197,028 shares of Class A common stock. On the divestiture side, the company has converted 424,423 shares of Class B common stock to Class A common stock. The company has a history of buying back its own shares. In 2024 and 2025, it repurchased $98.3 million worth of common stock. The total number of shares purchased in these 2 years is 6 million. Additionally, the company has an authorized stock repurchase program for up to $300 million. And that concludes the financial summary for ZETA Global Holdings CORP. Feel free to comment below, and I will be happy to answer them when possible.